Losers, they'll be constantly involved in the marketplace all the time. And it's about trying to find the value, isn't it? This is what we touched on in classroom this morning, this idea of trying to find value. And we've obviously done an article in Smart Alpha before about value. We've done an article about the idea of value. And the idea of value is this concept of fair value. If stocks are opening below futures, they'll add bids into the stocks. So if the futures is running ahead of stocks, then there's more likely to be a buyer coming in. If they're running behind stocks, there's more likely to be a seller coming in. So if you understand that and you accept that as a norm, if you accept that idea, and there's no reason why you wouldn't, because it's 100% the truth, and it's not me that's telling you, it's pretty much every single person that's ever been involved in trading tells you this about the PREM and what it is in terms of program trading, at least the ones that know the proper stuff. Then it's about trying to understand the S&P in that type of environment, isn't it? It's about trying to understand this concept of value added. And you know, one of the things that the dealers do is they look at this as a chart. This is just the PREM, that's all it is. And they start adding liquidity and subtracting liquidity when there's any value. So for example, this trade here, they added sell side liquidity up here. They started to offer into these trades here. And they managed to punch a quick price to the downside. They managed to punch a quick trade in there. Now, obviously, this is, if you practice doing this, you'll see how fast it is. I mean, that you just set up your demo account, get ready to go, and start banging in the demo account, right? So you start looking at the demo account on the S&P, and you start saying to yourself, right, what are they going to do here? And you wait for them to see some value. And you start saying, well, the value is dropping off here, so they're going to add some offers in here, and you quickly flash in all your offers here to try and capture the trade before it goes. And that's what you're trying to do as a trader, aren't you? You're trying to capture the offer before it goes, not after it's already gone. And obviously, when you see that and you start saying to yourself, right, what are they going to do next? You've no idea, really, do you? There's no particular way of being able to look at that and say, right, I know exactly what the trade is going to be next. And you start waiting for the next opportunity. The dealers just take whatever their position is and wait for the next opportunity. If they've managed to get net shorts, so if they like that short, they go in again and they hammer the sell side again. And if they like that, they hammer the sell. And if it then breaks south, they make money, don't they? If it breaks south, they make money on that net position. If it doesn't break south, they basically just bank that position and they start all over again. They think it's going to break south again, and they start selling into that break south, and they obviously get heavy into the short, and obviously if it starts breaking south, they start banking away those little checks. They start banking away those little checks, and then they start adjusting according to their overall view of what's going on in the marketplace. If they like the sell, they start accumulating, and this is what happens. They start selling into these areas. They start adding liquidity into these areas. They just go nuts into those price areas. And obviously, it's up to them to take on the trade if they want to take on the trade, and then they start filling in the bottom boxes in terms of outcomes, don't they? They start filling in the bottom boxes in terms of outcomes, and then they start again. They just keep starting again. And when you see those ideas starting to evolve, and you start saying to yourself, wow, these guys are on the ball here, and they start bidding into those, and they obviously are making micro adjustments as to how much buying and selling they can get away with in terms of these liquidity stories, then it's up to them to now play this market. It's up to them. If they start seeing the value starting to lose, they'll get a little bit more aggressive. 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 And they'll start taking their trade off below the market, won't they? They'll start clearing their positioning in here. Now, at any stage, these guys can close out their trade, can't they? At any stage, they can close out their trade. They can say, right, I want to balance out my I want to balance my trade. Now, I don't have to sit on the limit order book to do that. I can just cross the spread by, you know, if I want to close out the position, and I can start again. And I can start all over again. Now, that little trade didn't make very much. You know, we're just trying to show you something here. We're not specifically trying to make any money. But that little trade made about $150. that one trade. Now, it was a lot of trades to make 150 bucks, but you've got to remember these guys are doing a lot of business in these areas. If you think there's value building here, it's the same concept. They then start layering into that liquidity, because that's what they're doing in the stock market. They're layering into that liquidity. They're trying to build a short position in those areas. They want to buy in, they want to sell into this, and this is why we see the limit order book changing. This is why we see the limit order book changing, don't we? Because they're actually wanting to take on that inventory to see if they can make a quick buck on the downside of the move. And then they start booking the profits when they do get it. And if they can't book profits, guess what happens? They basically just bank the position and say, right, let's clear the position out and let's start again. And if they've got a standing position in play at that stage, they've got a standing position in play, and that's all they're interested in. They're not really interested in having to clear out their book. They'll just start all over again. And sometimes that standing position ends up getting cleared. Sometimes they just clear it, and that's it. It's ready to go again. It's ready to go again. That little trade just made another $100. It's not exactly earth-shattering stuff, guys, but obviously you can see that little sell trade was just selling into that spike higher here for that $100. Now, it's obviously driving higher just now, so there's no trade that you'd be taking on the short side, that's for sure. So obviously there's a couple of buy programs just kicked off here on the S&P, and it's driven prices higher. And it should be obvious about what you're doing. It should always be that obvious about that's what the trade is, that's what you're going to be doing in those price areas. When you look at it from a value point of view, you can see where these values start showing up. What we're trying to do is we're trying to get these trades to show up on both sides of this value line here. They want to be both negative. So you want to get that red or orange, and you want to be white as well, and you want them both to be below the zero. If they're both above the zero, there's no trade, and that's exactly what's happening up here. There's no trade. The dealers don't have any reason to be taking a liquidity position in this situation, have they? If the price is fair value, you're just going to take your adjustments in price, aren't you? But if the price starts to become unfair value, you start taking the adjustments in inventory. You've got a choice. You either adjust price, fair value means you adjust price. If it's unfair value, you build inventory, yes or no? That should be accepted by pretty much everybody that thinks about trading in this way. So you're obviously building value, you're obviously building price or value in two different ways, either by building inventory, by accumulating a short position or long position, or by adjusting the price liquidity according to the value that's forming. So obviously if I start seeing a lot of sell value, I'll accumulate a short position. If I start seeing a lot of buy value, I'll start accumulating a buy position. If I don't see any value and somebody buys, I'll adjust in the price action. I'll adjust by lifting the offers. If you see somebody selling, I'll adjust by pulling the bids. And the price candle will be bigger or smaller according to my adjustments. And that's when we see the kind of fading area. So you might be saying to yourself, right, I like this now. I think the dealers are going to be wanting to start building a bit of short inventory here because I see this dropping off here. Now, obviously, I should have done that a few seconds earlier, and I could have made myself a couple of ticks on that trade. As it transpires, I was talking at the time, and I missed the opportunity to do that bit of business. But that's up to the dealers to now take that or not take that trade on. And obviously, if they don't like the trade, they can always just go and basically cancel out the deal, right? They can always just cancel out the deal if that's what they wanted. Now, as it transpires, we managed to get away from that trade without costing us any money. In fact, we've managed to improve the position quite another little bit. We are now up. Since we've started this exercise, by the way, we started this exercise, the P&L on that account was up $5,422. It's now up $6,222. So it's been $800 of profit so far since we started this exercise, $800 of profit since we started it. So you might be thinking $800 isn't going to be very much, considering we've had at one stage we had 18 lots on in the S&P. But you've got to remember that this is constant by the banks. This is constant by the banks, and it's not 18 lots. It's probably somewhere in the order of 50, 60, 70, 80, 90, 100, 200, 300, 400, 500 lots. It's not 18 lots. So we're still trading quite small size here to try and see if there's any opportunity to generate. And remember, you always have that ability to press the exit button You've always got that ability to just close the deal altogether, that big closing position very, very quickly. And that's obviously how you play this. This is how you play these ideas. And you're just watching for fair value. At the moment, this looks as if it's all fair value, doesn't it? So what's the dealer going to do? The dealer's going to be adjusting by price action. Well, as a trader, you don't want to be part of that. You don't really want to be part of the fact that they're adjusting by price action. You want to try and figure out what the dealers are actually doing. And obviously, the dealers have been very, very short, predominantly very short in here. So we're waiting for that value to build to a big enough level that we expect a spring back. Well, there was a big enough level in here, and you can see what that was. The big level here was that buy trade there, wasn't it? So you can start to recognize that there was a big enough level in here to maybe take a little pop at some of that upside. So that's what you're looking for. The bigger the value, Alan, the better the opportunity for the dealers to make some money. And that's just the truth of every market, isn't that the truth of every single trade we take? Is if there's enough value to make money, we'll take it. So the dealers are watching, they're watching, they're watching, they're waiting. And obviously they're waiting to try and think about whether they build inventory. At the moment, they're not building inventory because they never really got a downtick to build inventory into. But you can do this on literally every single candle if you're fast enough. Now this is a 5-second chart, so we slowed it right down for you guys to try and follow along with, but we could obviously fasten it. We could quicken it up to 1 minute, 1 second charts, and the algorithms are going to go berserk into the 1 second trades, trying to capture one tick or not, as the case may be. And you can see that this uptick might give us a chance. We're going to be watching. That's gone negative in here, so you might say, right, nope, not yet, because the change just took place there, so it pushed it back up, so it took away the negative here. So I really want to try and see that getting more and more negative. And the bigger the negative, the better the opportunity for us to make a bit of business on this, right? So they're both kind of starting to diverge a little bit, but the divergence actually is on the buy side of this, on a macro scale, isn't it? A macro scale. 60 seconds is a macro in this one. So the bigger the divergence is actually on the buy side of this. So the price went up by 3 ticks. And that's okay, but the value's not really been good enough just yet to really take a swing into this bad boy just at this point, has it? So we're waiting to see if that gives us anything. I quite like the way that a sell is building now into this. And if we get a flash to the upside, we might just be able to make a quick short into this storyline. If we get a quick pop and then the algorithms change, the sell's probably the side to be on, and there's a quick flash sell coming in as we would have expected, a quick flash sell coming in. That was just a bit of a pity because I was waiting for just an extra tick on that. I think probably a price just up into the bracket high would have been a reasonable sell proposition to take a little bit of business against that. But nope, it wasn't there. So we go back and we wait for the next opportunity. And that's all you're thinking, is that the dealers will start accumulating when the dealers see any values. So when the dealer sees value, I'm talking about not just necessarily in one market, but there's starting to maybe be a bit of buy value in this. So the dealers might say, right, I'm going to go for this. And what happens is the dealer literally buys every single tick through that phase. They buy every single price. They put liquidity into every single price through that phase. And obviously their objective is to try and take a tick out of the market. That's their only objective, is to try and take a tick. And they'll keep buying into that, because the more they buy into that, the more chance they've got of making that tick profit, isn't it? The more chance they've got of making that tick profit out of that trade away from those areas. And obviously that's that little trade that they've just managed to make a little quick punch into, that little bit of business just there. So it's up to them to now manage out that exposure. And obviously you can see that that little trade's resulted in a reasonable little profit and an out. And that's us up to $7,000. So we've went $1,600 in profit on this storyline so far. So you might like this one. There's a little stop run coming in. We can see that. There's a little stop run coming in, and we go, okay, dealers are going to like that. So the dealers start putting in their bids. They start buying into these low prices, and they start thinking to themselves, we're going to make a fortune in this trade. And obviously they start putting in their exits all the way through that process, assuming that that's still the trade that we want. Assuming that's still the trade they're trying to get. They're just adjusting their liquidity. They're adding liquidity. They're taking liquidity off. They're adding liquidity. They're taking liquidity off against that value. And obviously what they're trying to do is they're trying to capture that little move for a tick or two, right? That's what they're trying to do, is they're trying to capture that tick or two move. And if they've got it wrong, guess what happens? If they've got it wrong, they just bank it basically, and they start the whole process again. So they just offset this $1,000. They take that 20 contracts, they shove it into the background. They don't do anything with it. And they start rotating their business again. They start rotating into their business again. They start the whole process again of buying into these prints at lower prices. They start the whole process of buying. Remember, these guys will buy thousands of contracts, not ones and twos. They'll literally buy thousands of contracts into this phase. And they'll be able to stop the market when they want to stop the market into this phase. And then they'll just bank it. And then they'll just bank it. And then they'll go back into this and say, right, we'll go back into the exit at the top edges up here. And they'll fill in the top edges with liquidity above the markets here. And they'll keep buying into these phases. That's all they'll do, guys. Exactly all they'll do through this phase is buy more and buy more and buy more and buy more. And eventually what will happen is they'll then clear their books on this uptick. They'll clear the books on this uptick, and they'll start seeing themselves moving in through a profit phase here. And obviously at that stage, they can then clear off the trade and then go back to the book again. Clear off their trade. Another profitable trade for the dealers. That was another profitable trade for the dealers, because they just bought and they added buys when the value got better and better and better. So they were able to clear off their trade there because they were accumulating on the way down. This is how the dealers make money all the time, because they know that they can carry on doing that as a process, something that you guys can't do. And so long as they get a little move back, so long as they get a little move back into value here, they can clear all their book and start again. And that's exactly what the dealers do. So you can see that we got both lines were negative in here. The value was obviously big enough for the dealers to really go for it, which is why we did. And obviously that gave you the profit on the trade right there. That gave you the profit on the trade right there. It's pretty good, isn't it? So something to remember about value, guys. It's just another little extra piece to your value considerations, is these ideas. It's not the most obvious. It's not the most easy to trade, but it is just that idea that value has to be something that you try and get consistent with. And it's not about consistency specifically from a correlation coefficient, because a correlation coefficient is all about a setting that you give it, whether it's a setting of 5 or 20 or 50 or 100. A correlation coefficient is about a setting, whereas your eye is all about consistency, that what you see is the right thing. And if it's the right thing, I want to do the business. I want to do the business. I can set up a correlation coefficient. I can set up a stochastic. I can set up all sorts of things that give me ideas. There's a big sell coming in on the S&P at the top edge for the top edge opportunity. I take the sell and I make some monies. I can get into the sell trade at the price that I'm looking for, and I can make some monies. I can start working hard into that sell trade opportunity. I can start adding liquidity. I can start becoming that dealer book. I can start doing what the dealers are doing, and that is accepting the sell. Now that sell's actually worked out quite nicely. You'll see that it was very obvious. Here it is here. So I just sold on that uptick. I took the trade on. I took a trade on there. My average price was 2 3/4, and I was able to get a very, very nice quick profit out of it. Not a lot of profit, but I was able to get a nice quick profit out of it, and stops at break even very, very easily, very rapidly, and absolutely no danger on the trade. So that was my sell trade right there. That volume came in after we'd started to sell into it. So it might have been a bit of our volume as well right there. So we started to sell into that storyline. And again, it's the storyline, isn't it? The storyline plus the volume. And then the sell-off comes in and we make a very, very nice profit for a very, very low risk. So you can obviously start to recognize some of these elements that start to sing the storyline. And it's recognizing when a really good value setting up as opposed to a pretty iffy value, isn't it? It's about recognizing the good from the ugly. The good from the ugly.